Now that we have talked about net sales and other revenues, it is time to focus on costs. To fuel its sales and produce the goods it delivers to clients, the firm must sustain certain costs. The most common expenses are cost of goods sold, selling, general and administrative costs, depreciation and amortization, interest expenses, and taxes. Cost of goods sold are expenses necessary to produce the goods the firm sells. Our dairy company must buy raw milk from local producers, transport, process, and then package it before it can sell it to the large supermarket chains. It sustains additional costs to produce cheese from the milk. The expenses that are directly attributable to the production of goods later sold are registered as costs of goods sold. Please remember that COGS include the cost of materials used to create the goods and the amount we've paid to personnel directly involved with the production of the goods. The difference between total revenues and cost of goods sold is called gross profit. This is the profit a company makes after deducting the costs associated with producing its products. Gross profit is one of the most important financial indicators for a business. Gross profit directly shows us how much our business makes from its core activity. Problems at this level are alarming. Because we have only considered the cost we sustain to produce the products we are selling, a negative gross profit would mean we are selling our products at a loss. If other revenues represent a substantial part of total revenues, you may want to subtract them when calculating gross profit, because we haven't sustained COGS for these expenses, and this will likely inflate our gross profit margin. Okay, next we will have the other large category of costs, selling, general and administrative expenses, also known as operating expenses. This is where the dairy company classifies its expenses for advertising and promotions, salaries of management and personnel not directly involved with production, accounting, office and auxiliary personnel, office rent, and utility bills such as electricity, phone, and water bills, nearly everything that is not related to COGS, D&A, or interest expenses. When we subtract COGS and SG&A expenses from total revenues, we'll obtain EBITDA, standing for earnings before interest, tax, depreciation, and amortization. EBITDA is one of the most popular measures of operating income. It shows us how much we've made once we considered both direct and indirect expenses. Depreciation and amortization are two accounts that reflect the using up of tangible and intangible assets. Depreciation refers to assets of a physical nature, while amortization is the term used for intangible assets, goodwill, licenses, copyrights, etc. Every year, the plants the dairy company owns become 1 year older, therefore their value is reduced. To account for such reduction, the company registers a depreciation expense. In our next lesson, we'll see in more detail how D&A is calculated in practice. Once we have considered D&A, we arrive at EBIT, earnings before interest and taxes. This is another measure of operating profitability, which obviously differs from EBITDA because it considers D&A. The nature of D&A, a non-frequently occurring item for most businesses, creates a preference for EBITDA. But there are companies spending a constant amount on D&A every year, therefore they prefer to use EBIT as their measure for operating profitability. Interest expenses are a cost a company bears for receiving financing. Typically, firms receive bank loans and pay interest expenses for the amounts they owe. The dairy company, from our example, had to ask for a bank loan when it acquired a new milk processing system. The bank agreed to lend the funds at an interest rate of 6%. Every year, the firm must pay an interest rate for the amount it still owes. Such interest expense is registered in the company's income statement as a cost. And finally, we have taxes. There are two things a person can't avoid, and one of them is paying taxes. Every firm pays corporate taxes that are proportional to pre-tax profit it generated. The rules according to which pre-tax income generated by the firm is measured may vary, depending on the country where the company operates. Once all expenses are considered, we arrive at the bottom line, which is called net income. This is the excess of revenues over expenses, the profitability of a business after accounting for all costs. These are the typical cost items you will find in an income statement. Later in the course, we will go through a complete case study and show you how the items are registered and organized to form a complete income statement. This will do for now. Thanks for watching.